Am I audible?
Yes, yes, start.
So for today, we'll be analyzing the company DLF, which is Delhi Land and Finance Limited. So talking about the company highlights, it was founded in 1946 and it started with the creation of 22 urban colonies in Delhi. And then in 1985, the company expanded into the then unknown region of Gurugram, and then it created the exceptionally living and the working spaces for the new Indian global professionals. And today, if we look at it, it is the largest publicly listed real estate company in India with spread across in almost 15 states and 24 cities, and catering over residential, commercial, and retail properties. So it is the first and the only organization which have received the which had received 11 Sword of Honor awards, which is conferred by the British Safety Council in a single year. So this honor is widely recognized as the pinnacle of safety achievement, which has been achieved by the DLF in the real estate sector over the world. DLF has pioneered the real estate evolution in India from the luxury malls to premium retail destinations with almost 65 million plus annual customers. Using its customer centric approach to develop residencies of highest standard that stand the test of times, it has spread across 11 cities and ranges from cutting edge luxury residential complexes to smart townships. With a legacy of 73 years with a core mission to provide the real estate development, management, and investment services as the highest caliber. So the company is listed on NSE and BSE, and also NCD. The non-convertible debentures of the company are listed on the wholesale debt market under the segment of BSE. Now, if we talk about the industry and the sector update, so the real estate sector is one of the most recognized sectors globally, and it has major four subsectors. Like if we talk about housing, retail, hospitality, and commercial. And the growth of this sector is well complemented by the growth of the corporate environment and the demand for the office space, as well as the urban and semi-urban accommodations. Also, the construction industry ranks third among the 14 major sectors in terms of the direct and the indirect, and all the induced effects in all the sectors of the economy. It is also expected that this sector will incur more NRI investment both in the short and the long term. If we talk like there are many structural transformations which real estate industry has seen, and some of them are RERA Act, demonetization, and the GST. This will eventually bring the confidence in the sector and will increase the transparency for sure. This sector is also witnessing the advent of new niche markets like co-working space, student housing, and senior living. Also, the government has allowed the FDI of up to 100% for townships and settlement development projects. And this industry is expected to grow almost around 13% of GDP by 2030. And we can consider the catalyst for this growth of like rapid urbanization and the increasing emergence of nuclear families and the rising household incomes. Now the QGLP will be continued by Krishna.
Yeah, hi. Talking about the business and management, DLF has already established market position, due to its track record in both real estate projects and residential and commercial too. The company has developed no fewer than 21 colonies in Delhi itself between 1947 and 61. then it was taken over by Delhi Development Authority. That's why DLF had to diversify into some other sectors like batteries, cables, and so on. So the company has already a robust operating rental portfolio, and it has a huge potential upside, and it is expected to grow it to around 50 billion rupees from 26.2 billion rupees in which was in financial year 19. And also DLF has land banks in prime locations across India, like Chennai, Hyderabad, and some other locations in India with around 200 million square feet domiciled in DLF and 26 million square feet in DCCDL. DCCDL is the DLF Cyber City Developers Limited. It is the rental arm of DLF Limited. And DLF brand has total dominance in both residential rental space, as I said, and the company's market position is like underpinned by its ability to create landmarks such as Cyber City and India's largest integrated business district, which is Gurugram, as we know. Basically, the interest rate reductions and increase in liquidity and proactively done by the RBI due to this COVID times, it has received well by the industry, and DLF has renewed focus in mid-income housing, plans to launch independent floors as well as having like ready-to-sell inventory. It has already a 9,000 crores of ready-to-sell inventory, which can be monetized later for if the company is facing any cash crunch in future. And talking about the debt, it's a very it's a big thing to like have a DE less than 1 for such a company like such a capital intensive sector. Although like it has so many investment in India, like in crores, but it still has DE of 0.13, which is quite lower than the industry average. And how it could achieve that level of DE? It is basically the GIC. It's a like wealth management firm of Singapore, and they partnered with them, and some promoters also infused a huge amount of money in the company, and that's why the deleveraging was done, and the D ratio was brought back to 0.13. And like, can you go a bit down? Hello, Vikas, you there?
Yes, yes.
Hello. Yeah. Like, although all the real estate sector, including like graded developers such as not only DF, I was talking about the Obro, Prestige, and Brigade, and all those big companies, they would definitely be like facing muted demand due to this COVID-19 and the pandemic era. And due to lack of liquidity in short terms, like it will vary from 6 months to 1 year due to this pandemic. But they would benefit most like all these companies. I'm talking about all the companies within this real estate sector. They will definitely benefit when the small and mid-level developers will go out of the business, and this will happen because as I mentioned before, it's a capital intensive industry, and they'll definitely have cash crunch within 6 months to 1 year at least. It will be sustained till the end of 2022, and most of the companies will like run out of money and they have to step out of the business. So in this case, because due to have a large portfolio in this sector, these big companies will definitely have an edge over other companies. And DLF is currently like 20 billion rupees of cash reserves against like 30 billion of debt maturity, which will be matured in fiscal year 21. And they are also looking to refinance it. And it's a pretty peculiar thing. When I went through the report, I got to know that they have also like provided a dividend of 1.20 in Feb. Like in this scenario also, and considering the like company in a real estate sector, they are also providing dividend. That means they have enough cash to like get over the cash crunch problem they will be having. And they're also with the existing joint ventures and all those promoters pumping in money, they'll again try to like reduce the debt level what was like declared by the management itself. So that's a positive for the company as well as the sector itself. And like yes, and yeah, talking about DCCDL, the rental arm of the DFL Limited is developing nearly 6.1 million square feet of the annuity asset. Means the company will be receiving rental from these sectors, and they are only in the last quarter only they received 30 billion rupees of rental income from DCCDL itself. And currently, the Chennai IT Special Economic Zone Phase 3 of zero point 0.8 million square feet is under construction. And in Gurgaon also, quite a projects are available and which are going on right now. Talking about the growth in earnings, currently they have 6 big projects in NCR itself, and two has already received occupancy certificates. Means the like if they are able to provide all the occupancy certificates with all the constructions what they have right now, so the end customer will be much more attracted towards company because it's already verified, and they don't have to wait for too long to like grab the opportunity or have their like home or office or anything. So that's a differently like definitely positive point for the end customers and the for company itself. And the recently today itself the quarterly result was declared and incurred like 70.65 crore losses this quarter, but it is quite less than what they had in the last quarter, like 1857.77 crore. That means the company is like doing well in this scenario also. And if we'll talk about the quarter one of quarter one financial 2020, so it was 414.72 crores. And the revenue from operation in June quarter declined to 58.8% to like 540.63 crores compared to the same period last year. And also this year, the management declared itself that they're, as I said, they're reducing their net debt in future, and also in this quarter only they reduced it by 42 crores, despite of this kind of challenging times. So that's a big deal. And about longevity and quality and growth, they have already 9,000 crores of ready to move in inventory, and they can easily monetize it in the next quarter itself. And yes, this is one thing they need to look towards, because retail mall segment is incurring too much losses for the company, because all the companies and like all the companies in this sector, they are having cash crunch problem. And also even if the banks are providing like moratorium for or like loans and even other banks are, they are not ready to lend money to companies right now. So this might be a problem for the like retail mall segment, but what we project that by the end of 2022 it will again fall back to places. With the operating rental portfolio of 32.43 million, DLF is the highest rental portfolio, as I mentioned. And the commercial office has also place of like 28.2 million square feet. And talking about price, due to negative earnings, we have the PE ratio minus 60.5, which is like insignificant, if we can say. But as per our projection, this will again come back to normal and positive in 2021. And right now, the industry average of PE is 35.94, and price to book value is 1.1, which is the more than the median of the industry it has right now. And PEG, price to earning by growth. What I did, I took the like historical PE and I took the growth rate. I took the analyst growth rate, how the EPS will grow in future, and I came to a value of 2.75, and it is also more than the industry average median, because there are some companies which is like they are currently outliers. They are not into this sector too much. And also, as I said, they declared a dividend of 1.2 in the last Feb, and it's a good for the investors and for the company itself. Over to Lisa.
Can you please change the slide? Okay, so I'm audible, right?
Yes, yes.
Okay, so coming to the graphs, the net revenue has experienced a steep fall in 2019 and is being rising slowly and is also expected to rise at a very slow rate. So the operating margin has also continued to go down due to increased variable cost in its operations. Coming to the next graph, the revenue growth has more or less stayed consistent in the past years, excluding that of the current year because of this whole pandemic thing. But when we look towards the net profit margin or the growth, it has fallen drastically during this year, depicting negative returns for the company as well. When we talk about the financial summary of the company, so the company is expected to grow well in the coming years and return to its initial momentum by the end of 2021 or 2022. So its net revenue did fall in the current year, but it's not a very major fall. So it would be returning to its initial margins really soon. Same is the case with the EBITDA margins. Subsequently, its PAT and ROI is also expected to grow positively in the coming years. Considering the dividend yield, DLF has been consistent in in offering the dividends and despite of all its losses in the profits, so it has also so that's a good point about this company because the investors can look ahead to it because there is not a much dividend loss in its part. The company is also reducing its debt year on year as they have a really huge cost of borrowing. So it has direct implications on its ROE. So it is focusing on reducing its debt every year. Coming towards the peer comparison, so DLF has a negative P ratio as of now and is the lowest among its peers, that is of Godrej, Oberoi, and Prestige Estates. So it is long back with the industry ratio, but it has the highest market capitalization and dividend yield. So it is a good stock from buyers' perspective, but earnings have been the lowest on its capital depicted by its ROC ratio, so which can also have implications in the future for the company as it has been offering the yields but is not earning as much as its competitors. So the company needs to look on this. Further, Isha would carry on.
Yeah, so now talking about the risk and concerns. The first is like the risk of not detecting a material misstatement. It means that any fraud that may involve the like collusion or the intentional omission by some of the internal persons of the company or the misrepresentations or the some of the override of the internal control costs. So these are the fraud, and this may result to a big cost to a company, and if the company is unable to detect it, it is a huge concern. The next is the completion risk, and it consists of the majorly four risks, which is the technical, construction, execution, and the operational risk. If we talk about the technical risk, it is caused by the technical factors like the what is the degree of innovation, the risk caused by the miscommunication, or like the poor integration between the design and the construction units. If we talk about the construction risk, it is the difficulty that the project owners or the sponsors face and they confront in the construction process. The next is the execution risk, which refers to like the issues and that arises due to the conflicts or the errors and which may cause the delay in the project schedule. And if we talk about the operational risk, it is the possibility that the project will not function as expected. It is something unexpected in the operation part. Like example, we can take capacity or the efficiency is lower than expected. And the next risk is institutional risk. This is different from the completion risk and all its subparts, as it is the delay in the completion of the project if any policy or the rules that are issued by the regulators and that affects the overall project progress is included in the institutional risk. So if we talk about, this was all about risk and concerns. If we talk about the conclusion and the investment view, like we if we look at the financials, there are many things like that give negative indication, but like P and many other financials. But if we look at the company as a whole, DLF has retained its positive rental outlook with sustained success in collections and business continuity support, and it has received a positive feedback from tenants. So, with a stable and the positive EPS and its projected ROE of 4.8%, and the various financials of expected PE is 22.2, we can expect that the stock price will go up till 158.9, and hence will recommend for the buy and maintain. Also, the we can say that demand may initially remain muted, but yes, due to the strong brand image and the commitment to quality of the company towards its customers, it is expected to ensure a healthy revival again very soon. According to the current pandemic situation, we are looking at the de-densification concept, which means that potentially which will lead to the potential like increase in the area leased in order to accommodate for the physical distancing requirements. So according to the pandemic situation, the company has projected that it will that it will perform better in the COVID-19 and post COVID-19 times as well. Also, the DLF has continued to maintain the comfortable levels of liquidity to meet its business requirements, and it was able to meet all its financial commitments without availing for any deferment to the moratorium, despite of being the pandemic and the uncertainty situation in the environment. Also, the company is focused on improving its free cash flows, as was told earlier, and enhance its return on equity with largely completed inventory on its books. The best part about this is when I went through this report, I came to know that the company is majorly focusing to monetize its book and to get the cash out of its already built up on inventory, and with this it will be able to get the cash and utilize the surplus cash flows primarily for the debt reduction, as has been mentioned by the Krishna, and the balance sheet surplus will be utilized by the company to both reward its shareholders as well as to reinvest in development of new projects. So the company is expected to perform better and has targeted to monetize all its ready to occupy pan India inventory. So this is all about the company, and we are open for questions now. Thank you.
Thank you guys. Nice and good presentation. So, any questions, guys? Is there any question, guys? Or we may wind up this session.
Because there is a question in the chat box.
Yeah, yeah. Krishna, can you go through the question? Arisha or Anushi, anyone can address the question.
Or go through the question. Sorry. So asking with the demand slump, experience and the scarcity of labor, how does the company plan on reviving its revenue? Yes, talking about revenue, see, obviously the revenue part for the last quarter, that's why the revenue, they did not meet the expected revenue for the last quarter. That's why they had to face the negative profit. But with as well, with that also, they tried to maintain their margin, and even they have developed their margin since the last quarter, if you check it properly. So obviously, this is the time that nobody will have that much of revenue for this kind of sector. So as far as revenue is concerned, it was like if you compare the company with the other companies existing in the like this segment, it is quite well. And even this will be these are expected to increase for the next and the next 2 quarters, because as I said, they have already inventories worth 9,000 crores, and they will easily monetize it. So I hope that answers your question.
Adding to Krishna's point, if we look at the report and the investors' presentation that they have given, so the company has majorly focused on the cost management rather than focusing on the revenue part much. And what they have done is they have effectively find out the way how they can reduce their cost so as to maintain the balance between the two. So they have conducted the extensive internal exercises, and they have targeted a substantial reduction of overheads by eliminating the non-essential costs. And they have also poised out they have gone to much leaner and far more efficient organizational framework as a result of this cost management activity.
Yeah, guys, actually, I have a question. Where do I come to
Yes.
this number 158.9, like the stock price, regarding stock price?
How did I come up with the number you are asking, right?
Yes, yes.
Yeah, see, because what I did, till 2019, I checked for like 4 5 years, and the PE ratios of the company as well as the industry itself. So I came to a number that I expect what I expect. I'm not over assuming, or I'm not pessimistic about the PE, but I kept it around 22 point, like 23, and I made it to 22 at last. Then again, what I did, I checked for the analyst growth in this sector, like analysts are expecting to have the EPS increase towards the end of 22 or 23. Then I also found the EPS growth rate, and from those two data, I came up with this 159. What we are talking about, the stock price, because I got the PE and I got the EPS. Then it's easy. It's just you need to multiply the numbers to land at the numbers, right?
Yeah, yeah. Look,
Yeah.
for the next 1 year, we are expecting this price movement up to this price.
Yes, exactly. Because we are not focusing on the technical analysis over there. Because whatever projections we're doing, we are doing it for 21, 22, or for the long term, right? So it's no I didn't find it much more better to put the technical analysis over there. So in a long term, I expect by the end of 2021, they will definitely the share price will spike up to 160. What I expect right now.
Yeah. Okay, but
And one more question, it was there. Someone was asking about the leverage ratio. It was almost to zero, because what happened? They after the collaboration with GIC, as I said, this is the wealth management firm of Singapore. They had they collaborated with the GIC, and also promoters infused a huge amount of money. because they knew that if they won't be infusing money in this time, then definitely the whatever the top line or the bottom line, everything will fall due to this time. Right? That's why they pump a huge amount of money, and it has already like 25 billion of cash in hand. If I'm talking about what I remember in 2005 to 2006, if you look at the Apple's balance sheet, they had around 300 billion of dollars of cash. So cash, the company retains cash because of three reasons. One is they will definitely go for any merger acquisition in the near future, and they might have some problem like this COVID pandemic, and they might be going for some insurance, because you don't know, because they have to has their risk with a commodity or a foreign exchange risk. So these three are the major problem. That's why the company needs to hold a huge amount of cash. And if you are inside India, if you can see, 25 billion is not bad. And also 2000 in 2020, and they're again raising that level. So I don't think, even they also provided dividend, and the company management is not so full that they will provide dividend at this time. So they have enough cash at the hand in their hand. So that's why the debt level became zero almost